Welcome. My name is Peter MacDonald Eggers. I am a barrister specialising in the practice of commercial law, in particular insurance, shipping and international trade law. Today I will be providing you with an overview of Section D of the course on marine insurance law. Now, Section D is headed Indemnity, Subrogation and Contribution. Now, what it's really concerned with is the consequences of there being a valid insurance claim under a marine insurance contract. Now, before I discuss the individual topics which are addressed in Section D, I should first point out the way in which each of the chapters in Section D are structured. Now, they begin with a reference to the relevant academic texts and other relevant literature. And then it refers to all the relevant cases, not all the relevant cases, but the more important ones. And indeed, the most important ones are identified by an asterisk in your guide. Now, once the cases are considered, the guide then proceeds to consider each of the relevant legal principles which can be derived by a consideration of the relevant authorities. And the chapter ends by setting out the summary of what you should have learnt by a review of the relevant authorities and the legal principles. And finally, there is an activity and feedback session in order to test your understanding of the legal principles as a result of your review of each chapter. So we move on to the topics covered by Section D. Now, the topics are threefold. The first is basically concerned with the consequences of there being a valid insurance claim under the policy. And I'll come back to that. The second is concerned with the insurer's rights of paying a valid insurance claim. And finally, the section ends with a consideration of the rights of third parties as far as the marine insurance contract is concerned. Now, focusing on the first topic first, which is the consequences of there being a valid insurance claim. Now, what we're really concerned with here is a scenario where the assured has demonstrated that he is entitled to an indemnity from the insurer because he can demonstrate that he's suffered loss or damage by reason of an insured peril. And when I say by reason of, I mean proximately caused by an insured peril. So that means, for example, an assured owns a ship. The ship is sunk by virtue of a storm at sea, and that storm at sea is an insured peril under the relevant policy. And the question arises, how much can the assured recover from the insurer? Now, this notion of the amount or quantum of the entitlement to recover an indemnity is often referred to as the measure of indemnity. And the amount recoverable depends on a number of legal distinctions. Now, the two most important legal distinctions are as follows. The first one is the distinction between a total loss on one hand and a partial loss on the other. And of course, a total loss considers, in most cases, the extinction of the asset insured, whereas a partial loss is concerned with something other than a total loss. Now, the second most important distinction to bear in mind when considering the measure of indemnity is the nature of the loss or damage sustained to the subject matter insured. And the two ways in which loss or damage may be sustained are by virtue, firstly, of physical damage. So, for example, a ship is dented by reason of a collision, or it sinks at sea. Alternatively, that the cargo on board a ship suffers heat damage or mold, or is destroyed as part of an explosion. But the second type of loss, which is encountered as part of this area, is what's often referred to as deprivation loss. This is where the assured is deprived of the free use and disposal of the property insured. Now, deprivation and loss may arise even though the subject matter insured, the ship or the cargo, is not physically damaged. And what we're concerned about here is where the property is taken by a thief or by a pirate or by anyone for that matter. And that's where the assured, whilst the property still exists and still may be in good condition, but the property is no longer at the free use and disposal of the assured. So these are sorts of considerations which are taken into account in formulating the specific amounts recoverable by an assured under a marine insurance policy, and hence the name measure of indemnity. Now, the second topic which will be explored as part of Section D is concerned with the rights of the insurer as opposed to the assured upon making a payment of an insurance claim under the policy. Now, essentially, the insurer acquires two individual rights, and they're closely related, but they are distinctly different. The first one is so-called right of subrogation, and this basically allows the insurer, subject to very strict rules, to exercise rights available to the assured in respect of the subject matter damaged. Now, this is the whole point of this exercise, is to ensure that the insurer can diminish the loss he's paid out to the assured under the marine insurance contract, but secondly, to ensure that the assured himself is not over-indemnified in the event he makes a recovery, for example, against the insurer, but also, for example, against a third party. Now, the second specific right which is acquired by the insurer is the right of contribution, and this arises where the assured has the benefit of double insurance under the in relation to the subject matter insured. So, for example, he might own a ship, and he's got two independent policies covering the entirety of the interest of the ship. And in that event, if one insurer pays out, he may be entitled in certain circumstances to recover a contribution from the other insurer. And that's a right which is acquired by the insurer upon payment of a valid insurance claim. Now, the final topic which will be addressed as part of Section D is actually not concerned with the rights of the assured or the insurer, but rather the rights of third parties. And the important aspect of the rights of third parties arises because they are not an original party to the insurance contract. Now, they can acquire such rights because by way of assignment, and now that's a topic which is considered at more depth in Section A of the course, but they can also acquire rights to enforce the insurance contract independently as a matter of law, principally by way of statute. And there are two relevant statutes in this, as part of this process. The first one is the Contracts Rights of Third Parties Act of 1999, which entitles the insurer, the third party, to enforce any promise made in the insurance contract for his benefit, even though he's not a party to the insurance contract. The other principal statute is the Third Parties Rights Against Insurers Act of 1930, which has been actually replaced by the equivalent act of 2010, but the 2010 act is not yet in force. And this is an act which gives certain third parties rights to proceed against an insurer directly, where the assured against whom the third party also has rights has become insolvent. Now, these are complex areas, and it's important to consider these statutory provisions in Section D in some depth. But overall, Section D is concerned with basically the operation of the principles which govern the rights of the assured, of the insurer, and indeed of third parties when it comes to a valid insurance claim. Now, they're important to the understanding of marine insurance law, but they're also in their own right interesting and hold much academic interest. And therefore, for that reason, I hope you will benefit both practically and academically from a review of Section D.